Hey guys, it's Harona, and today we are going to be opening my package that I got in the mail. I got in the mail on Sunday, and we're going to be opening it up. It's a little, raggedy, just a little bit. This is how it came in the box. I guess my mailman really wanted it to fit in that little mailbox that we have, but it's still together. It's not, damaged or anything, just the top. And so we're gonna go ahead and open it. For some people watching this video right now, you already know what this is. For others, you're just gonna find out. Okay, so we're gonna pull it, and I'm turning it this way so it doesn't have show my address. So, it's coming, it's almost there. So we are opening this, so the packet is gone. And I'm gonna take off the sheet with my address on it. Oh, all of them have my address on it. Oh, this is so cute. Okay, so this is what it is. It is my life insurance package, and it comes like so. I'm gonna try to hide my address in this so cute book. It comes in like a book. This is so cute, guys. So this is my life insurance policy. Well, it's not my policy as in I'm the insured on it. I own the policy, and I also pay the policy, but the policy is actually on my sister. So I'm gonna explain a little bit more, on why it is on my sister rather than me. But I just wanted to just go over a little bit, right, about what's in there, what comes with this policy and all of that good stuff. So this policy is what is called, I'm trying to see if my address is on any of these pages before I try to share it. So my address is not on this page, but it does have my sister's name and policy information. Let's see, I'm trying to see if I can share it without sharing too much information. No, it has my phone number in there, and it has my sister's name and policy number, so I can't even show you guys too much. So I'm just gonna talk and try to explain. But it's what's called a IUL. I just blanked. It's called an IUL, which stands for Index Universal Life Policy. And what that is it's a policy. It's not like invested in the stock market or anything like that, but it is modeled off of an index, meaning the way how an index such as like the S&P 500 or one of those, you have the global index as well. And there is another one, there's 3 of them that you can choose from, but it's not invested in the stock market, but it is modeled off of an index, which means that however the index performs, if it performs well, that's a lot of cha-ching for you in this policy. And they also have a guarantee. So even if the indexes perform poorly, there's a guaranteed interest rate or percentage of interest that you're guaranteed in this policy when it comes on to your cash value. So that's what we're really talking about. So basically, in layman's terms, to break it down so it doesn't sound too complicated for you, this is a permanent policy, right? So going back to basics, it's a form of permanent policy. It has a cash value, but the cash value in this kind of permanent policy grows much more than the regular whole life. So this is not a whole life policy. It is called an IUL, and it's modeled off of an index, which means that it grows by an interest rate, an interest percentage. So it grows faster in cash value than a regular whole life policy. Whew! I think that should do it, okay? That should do it on the explanation. So I'm gonna skip through. This is just like an intro page. I wish I could show you guys this, but it has my sister's information on here and policy number, so I can't show it. So this policy comes with some great stuff. You have But I'm not going to say everything because I don't want the video to get too long. But what the most important thing that I wanted to highlight that it comes with is minimum monthly no lapse premium, right? And it has a no lapse period. So I want to explain really quickly what that is. This means that depending on your age or wherever you fall in, there's a certain amount of period of time in these IUL policies where your policy cannot lapse if you pay a certain amount per month. I'm not going to say the amounts in here, but what I will say is that the monthly premium in this policy is a certain amount, and I'm going to give a number. For example, let's say it is $100, right? When you have no lapse in a policy like this, there is a certain amount that you can pay. So for example, let's say that you had a policy and you couldn't pay, like you fall into some hardship, like you lose your job or something of the sort, and you couldn't pay for the policy, right? There is a no lapse depending on your age. So there's different, age period from 0 to 60 or 61 to 85. So basically, if you're between the ages of 0 to 60, you have a lesser of 20 years or until you're 65. So in my sister's case, she is 20. So that means that she has 20 years, right? So lesser of 20 years. So because she's 20, that means that she has 20 years because it goes up until age 65 and you get a maximum of 20 years, right? And she falls in between that 0 to 65, so she gets the full 20 years. So for 20 years, if this policy, let's say the premium is $100, but there's a no lapse that you pay where if you pay that minimum, the policy will not lapse, meaning it won't cancel. You always have the policy, and this lasts for 20 years. Let's say it would be about $50 or $49 instead, right? So let's say that your policy was supposed to be $100, but you fall into some hardship, right? And you couldn't pay, right? You're having a trouble or a hard time paying and keeping up your policy, but it's very important that your policy doesn't lapse because this is important to cover, any illnesses or in the case of death or anything like that. So it's important to have in your life, right? And we're going to talk about it a little bit, but it's very important to have so you know that this is the one thing you cannot afford to cancel. You can cancel Netflix, you can cancel any subscriptions you have out there. You can cancel your cable for, you don't need your cable, but you need your life insurance policy in case you get sick or in the case you die, right? You do need that so you can let everything else cancel whatever you're paying for that you don't need to be paying for. You can let that go, but this is the one thing that you should make sure that you are making space for, and the no lapse helps with that. So instead of trying to find that $100 to pay that $100, you pay $49 or $50 instead, right? If the policy that you were paying was $50, then it would be about $25 or so that you would have to pay. So it's not necessarily 50%, but when you calculate it, it comes out to about 50% or more, or sometimes less. Like the amount that you get to pay is really, 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 really small in comparison. So it takes off a chunk. So don't quote me on 50% because it doesn't have to be 50%, but it does reduce that amount by a good chunk that you don't have to pay, and you can still keep your policy, right? So that's the first thing I wanted to highlight, and it's guaranteed for the whole 20 years. Now, let's say it was somebody that was 40, right? So you would have, it's until age 65, so you would still get that 20-year period. Now, when you hit 61, it reduces to 5 years because that's 5 years away from being 65, right? So cool. Cool. All right, so let's see. What's the next most important thing that I wanna to tell you? Ooh, listen to this. The policy owner may make withdrawals after the first policy year up to the available withdrawal amount. Right? So what is that talking about? That's talking about the cash value that's building up in the account, right? So it's telling you that in this policy, this specific policy that I have, after the first year, whatever money is built up in this account can be withdrawn. Like you can call up the company and call them and be like, hey, I got, you know, $3,000 in my cash account or my cash value, or I have $1,000 or $2,000 in my cash value, and I would like that, right? So you call them up and you have them send any amount that you have in your policy to you. So, which obviously I'm talking about cash value, so that's a feature in this account because it's a permanent account, and we already know that permanent accounts come with cash values, right? Awesome. Okay, so I want to talk about living benefits. Now, this is the kicker in life insurance policies these days. And it is in this policy because it's a permanent policy. But before I go any further, I want to let you guys know that living benefits with our company also comes in the term policy. We have a term policy that comes with living benefits as well. So for those who don't know what living benefits are, it is the point where you get to use your coverage or death benefit or face amount, whichever one of those you want to call it, is talking about the same thing. You get to use it. You get to accelerate it, meaning the company cuts you a check for up to 90% of the coverage if you were to become critically ill, chronically ill, or terminally ill. Right? So that's the kicker. And we have a term policy that comes with those riders, with those benefits. How crazy is that? So we all know that term policies don't usually come with anything but to give you a certain amount for a certain amount of time, right? So our company is one of the first to add those benefits in there. So many companies that you're going to find still don't do it in the term policies, right? So it's something special and something worth noting. So in this policy, it does have all three. So it has the chronic illness accelerated death benefit rider. It has the critical illness accelerated death benefit rider. And of course, all of our policies come with terminal illness accelerated benefit rider. And again, you get to accelerate up to 90% of your the coverage, death benefit, face value, however you want to call it, if you were to become critically ill, chronically ill, or terminally ill. So I'm going to read just really quickly because I know this video is getting long. So it says, I'm going to read from the critical illness portion of it. So it says, the policy owner to accelerate a portion of the death benefit if the insured becomes critically ill. A critical illness is having been diagnosed by a physician with one or more of the following health conditions or underwent one or more of the following medical procedures. Whether you had a heart attack, a stroke, cancer, kidney failure, major organ transplant, blindness and paralysis, loss of use of two or more limbs. That's what it means by paralysis. Please see the policy for complete definitions of qualifying conditions. I'm going to quickly read the one for chronic illnesses. This is chronic illness accelerated. Allows the policy owner to accelerate a portion of the death benefit if the insured becomes chronically ill. Chronically ill means that the insured is unable to perform without substantial assistance from another person for a period of at least 90 days, at least 2 out of the 6 activities of daily living, or requires substantial supervision by another person for a period of at least 90 consecutive days to protect the insured from threats to health and safety due to severe cognitive impairment. The activities of daily living includes bathing, continence, dressing, eating, and transferring. Listen now. So the chronic illness accelerated death benefit that allows you to accelerate up to 90% of your policy, what you have in your policy, the coverage at face value, the death benefit, same thing. If you cannot perform 2 of your daily living, daily living activities for 90 days, right? For 90 consecutive days, so 3 months. If you are, bed-stricken or whatever happens, if something happens to you and you cannot bathe yourself or you cannot dress yourself or you need assistance with eating or going to the toilet, transferring, anything, at least 2 of those, right? Any 2 of those that you cannot do for a period of 3 months will consider you under that chronic illness umbrella, which means that you can call up the company after 3 months and be like, hey, I have been confined for the last 90 days. I have someone here in my home who has to help me to eat, who has to help me to put on my clothes, who has to help me to bathe, who has to help me to use the toilet. Right? You call them up. Of course, you have to have your proof. You have to have, your doctors. It has to be something that is actually serious and actually happened to you. So you can't call and make stuff up, right? But if anything were to happen where you were not able to perform 2 of those daily living activities, again, bathing, dressing, eating, etc., you can call up the company after 90 days, let them know, and they will cut you a check for up to 90% of the benefit that you have in here, right? So if you have a term policy, and that is $700,000, and you became chronically ill where you couldn't bathe yourself or eat on your own or use a toilet on your own for 3 months, right? If you're bed-stricken and you need help with at least 2 of those activities for more than 3 months, or when you hit that 3-month period, you call up the company. And if you had, let's say you had a term policy with the living benefits on there and you got $700K in that policy coverage, you call them up and you can get a check for up to 90%. 90% of 700K would be $630,000. You can call them up and accelerate up to that amount, right? And I don't know, if I'm the only one who sees the benefit in something like that. And you don't have to die to use it. That's a great thing, because month 4 can come. As a matter of fact, you could be better a week after the 3 months, right? So 95 on day 97, you could be perfectly okay, but you would have already gone to that 90-day period where you were able to accelerate up to that amount. So it will help you cover all those expenses that you had in the last 90 days. You get to cover those. You get to, if anything had happened where you probably lost your job if you were home for 3 months and couldn't move, you probably lost a lot. So even if you became better, if there's some miracle that happened to you and you were healed like a week after, so on the 97th day, you would have already passed that 90-day period, and you would have already been, you would have gotten your check, right? Of course, you probably won't get your check that fast, but I'm saying at the 90-day period, you would be able to call a company and start the process of accelerating up to 90% of that check. So if you had a $700K policy, you could call the company and get up to $630,000 sent to your house in the mail in the form of a check that will help you to cover all the expenses that you would have to incur over the last 90 days, right? And going forward, of course, there's gonna be that transitioning period to pick your life up, pick the pieces up. If you've been home and confined for the last 90 days, you probably have a lot of financial stuff that needs to be taken care of. And so that's what that $630,000 check, or up to that, you know, so I can be correct, politically correct, up to that $630,000 check could most definitely help you, push you even further than probably where you were before you had that policy, right? So that's something very, very, very important. And of course, the policy has a lot of other moving parts, but those are what I wanted to highlight so the video doesn't get too long. But I did also want to touch on and the interest rate that when we run the illustrations for you, when you get when you do your quote with me or, you know, at our company, we run the quote for the IUL policies, and the interest rate that it illustrates for you is 7.7%. However, it can go up to 13% or 15%. Don't quote me on that. It's one of the two. I have to check it real fast again in order to verify, but it's either up to 13% or up to 15%. So it could perform way better than what they, you know, estimated for you, but the estimate is 7.7%, which is a lot of money either way, right? So if it actually performed better and perform at 13%, that's obviously way more money for you. But at 7.7, it's still pretty freaking awesome, right? And so I wanted to touch really quickly before I sign off. You know, so I did mention that the policy is, even though I own the policy, but the insured is not myself. You know, and I just wanted to explain it a little bit. So, you know, when you get your license as an agent, the first person, you know, estate that you want to plan, and the first person's financials that you want to plan is yourself. You know, that's a smart thing to do, because you can't be out here telling people, you know, they need to protect their life when you're not doing the same thing. So how would you know? Like, I mean, I'm sure you've had experienced death, but still, if you've experienced death and you know the importance and you're selling something, then you probably should cover your life as well. So like most agents, that's the first thing I did too, but unfortunately, you know, I was not approved for one, and I can say that now, but when I just got denied, I couldn't. I've been denied for weeks now. And, you know, I just started talking about it. This is the first time I'm talking about it, because it really, 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 you know, affected me a lot, especially since I applied, you know, with the company.